Hi everyone, welcome to HLS. I am Hema Iyer. You can visit my website to get to know me. I'll give you the detail at the end of the video. And this video series, I am doing it or I am preparing it for the benefit of the students who are struggling with these IFRSs, especially SLFRS 15 or IFRS 15 for various exams that they are preparing. For example, AAT, ACCA, CEA, CMA and so on. Nowadays this IFRS has become very popular and there are jobs coming up as IFRS specialists. And they are asking for equivalent or ACCA diploma in IFRS as a must. So that indicates that it is going to be the future career for a IFRS specialist. So you have to be thorough with this, and it indicates also, it's an evidence that your examiner in this business reporting or financial reporting examination going to be more and more deeply examine you whether you are thorough with the principles and have the capability of applying the knowledge in the examination purpose. So today I am going to focus my discussion on SLFRS 15, that is IFRS 15, both are the same, which has been adopted by our chartered accountants. So there is no much difference. There is no difference as well between the two. So this SLFRS 15, IFRS 15, the title is Revenue from Contract with Customers. So if you are talking about the IFRSs, I have observed that the examiner wants to know the principles of these standards very thoroughly understood by the student, where they can apply that in the exam scenario. I am going to discuss focusing myself in the exam angle, not in the life practice angle, because in Sri Lanka how much we are practicing are beyond our scope of this video. Actually I am going to focus for the exams, how you can satisfy your examiner by applying your knowledge. So there are twofold that you can do. You have to do two things. One is you have to learn thoroughly. Second thing, you have to apply the knowledge to the scenario, whatever they are giving in your examinations. So SLFRS 15 or IFRS 15 is one of the new standards and widely discussed, and it's one of the main standards because it's concerned with the revenue, the main component in your financial statements or the business. All the business are focusing on revenue. So how you are going to give the accounting treatment for revenue is widely discussed by this standard. So this standard supersedes your earlier IAS 18, where there were so many other definitions which has been superseded by SLFRS 15. I'll discuss those things in another separate video, IAS 18 versus SLFRS 15. This video, I'm going to focus in one area. I will tell you about that. First of all, I will introduce revenue from contract with customers. So this standard focusing on three key points: revenue, contract and custom. So you have to make sure that there is a revenue as per the standard definition, and there is a contract as per the standard definition, and there is a custom as per the standard definition. Then only you can apply SLFRS 15 or IFRS 15. Otherwise, it will go into the other standards such as lease, SLFRS 16, IFRS 9, financial assets, or IFRS 11, joint arrangements, SLFRS 11 or IFRS 11, joint arrangements. So it can go to those standards, some other standards. It won't come within the scope of IFRS 15 or SLFRS 15. So you have to make sure that there is a revenue. Revenue is defined in your standard here as the revenue from ordinary activities such as sale of goods and services. It's from the ordinary activity. If you are selling an asset, that is not an ordinary activity. It's a disposal of an asset. It's a gain. It is taken care of with the other standards. It won't come within the scope of revenue within SLFRS 15. So next is a contract. There are 5 criteria in the standards they are given. It should satisfy all 5 criteria to make sure that there is a contract exists, and a contract should exist with a customer. Make sure that your counterparty is a customer. If the other party has some interest in the entity's performance or operations, then it goes under IFRS 11. So you have to be careful that you should have revenue, contract and customer as per SLFRS 15 or IFRS 15 to apply this standard. Then we coming back to these standards. This standards was introduced on the 28th May 2014 by IASB, International Accounting Standard Board, and it is adopted from 1st January 2018. Or even an earlier period is allowed. Though it is a single and comprehensive framework because it covers revenue for all the industries. Even the IAS 11, construction contracts, and IAS 18, revenue, has been superseded by this standard. That means both of them have been merged. Even the revenue from contract costs will come under this standard now. The revenue is all a wide application of this standard for all the industries. So it's a single and comprehensive framework. So this says how much revenue to be recognized and when. How much revenue to be recognized when and how much. So the amount and the time are important. The timing of the revenue recognition and the amount of revenue recognition are important. So these 2 key points are covered in 5-step model. The core principles of this SLFRS 15 or IFRS 15 is covered by 5 steps model. You know the 5-step model. I need not to elaborate on that because from A level you have been studying this 5-step model. You all know the 5-step model. One is identify the contract, identify the performance obligation, determine the transaction price, allocate the transaction price, and recognize the revenue at a point in time or over a period of time. You have been memorized this standard and you have mentioned that in various examinations. But now you have come up to the advanced stage in the examination where each standard has to be scrutinized in detail. You should know what each steps, what each step says you and how you can apply these steps to your scenario. It's the challenging factor in your examination. And your examination questions I have seen you, it is brief scenario, about 5 or 6 lines, but put you in confusion. Even a 10 marks question put you in confusion. I have seen that the students are much confused with these standards. So, for the benefit of the students who are struggling with this standard, I am publishing these videos. So now I am going to concentrate on the 3rd step. You might ask me why I am taking this 3rd step for the first video. Because the transaction price is the amount that you are going to recognize as revenue. So how you are going to determine this transaction price is a key challenging task. If you take up various industries, it is not just as invoicing goods and services straight away. Not easily mentioned as writing an invoice. It's not like that. So you have to determine the transaction price. So there are 4 components which comes in this determination of transaction price. One is there are variable consideration associated with this transaction price, like discounts, rebates, all that. We will see what it is. Then there is a significant financing component. That means if the payment made by the customer are in arrears or in advance, there is a time value of money which we have to adjust in the transaction price. Then there can be non-cash consideration which has been paid for the transaction, which you have to take it as a revenue. Maybe the fair value of the non-cash consideration or the standalone price of the goods and services that you are supplying. We will consider that later. Then the 4th one is consideration payable to customer. You might wonder, what is this considerable payable to customer? Customer has to pay us, why should we pay? It happens like this. Some manufacturers sell the goods to retailer at one price. Then the retailer sells manufacturer's goods to the consumers. The manufacturer goes and gives coupons to the consumers. They bring the coupons to the retailer and get a discount. So the retailer has to sell at a discount. So what the manufacturer will do is, in certain cases, they will reimburse the retailer. So retailer is the customer for manufacturer. So the retailer will get the payment from the manufacturer. That is the payment, that is one type of payment. There are several other types also there. Consideration payable to customer. These 4 components affects the determination of transaction price. So in today's video, I am going to discuss the variable consideration. What is the variable consideration and how we can bring that in or adjust the transaction price with the variable consideration. So we will discuss that for another 10 or 15 minutes. Coming back to the variable consideration, first you have to decide the fixed price. There should be a fixed price for the transaction. For example, if you are a construction company and you have a customer for say you are X and the customer is Y, you quote a price to construct a building for $10 million. That is your transaction price. Okay. This transaction price has to be adjusted by the variable consideration. For example, the variable consideration can include awards and penalties. That means if you complete the job within a specific date, you will get an award. That means the customer will pay an extra. Or if you delay the contract, you have to pay the penalty to the customer, or he will deduct from your consideration. For example, if you delay, he will deduct 5 lakhs. If you do it before the time limit, you will get 2 lakhs. So you have to adjust your transaction price, which is fixed as 10 million. It depends on the situation. But you are not sure about that. Whether you will complete it in time or before time, or you will delay it and incur a penalty, you don't know. It is a kind of variable consideration. So this variable consideration has to be adjusted with your fixed price. So the variable consideration can be plus or minus. It can be a award or an additional price, or it can be a penalty. So there are various kind of variable consideration available. Discounts, rebates, penalties, performance bonuses. There are a lot of variable considerations comes in the transaction price. Sometimes the company or the entity has a practice in the past giving price concessions to its customers. It's just a practice. So it creates an expectation from the customer's mind that, okay, my transaction price is 100,000, but after completing the transaction or buying the certain quantity which has been contracted for, I will get a price concession. It is an expectation. So this expectation is a variable consideration. Sometimes the output is not defined. For example, in a mining industry, you are selling ore, copper ore. You sell about 10 tons of copper ore to a customer. But only when the customer extracts the copper, he will know the actual quantity of copper what he has extracted, and your contract is based on the actual quantity of copper what you are going to supply to the customer. It is again a variable consideration. So this variability means uncertainty. Variable consideration means uncertainty. And this uncertainty has to be resolved at a time. Sometimes it's very quick, sometimes it is taking a longer time. So how are you going to take this variable consideration into your transaction price is the problem. How can you ascertain the variable consideration? So the standards prescribes two methods. One is expected value method and the other one is most likely method. If you have outcomes or if you have various outcomes, more than 2 or 3, then you ascertain the probability of those outcomes and calculate an expected value. Maybe the expected value is not a real outcome of the transaction, but still, if you feel that it is appropriate, based on the facts and circumstances, you decide this amount is correct. Or otherwise, most likely outcome. If you have only two options, for example, a performance bonus. If you perform, you will get a bonus. If you don't perform, you won't get a bonus. So only there are two options, yes or no. In that case, you can take the most likely. If you have a 90% chance of performing the outcome or performing the project, then you take 90%, I have a chance of getting the performance bonus, and add the variable consideration into your transaction price to recognize the revenue. In between there is another step where the transaction price has to be allocated to the performance obligations. That I will discuss it in another video. So here, how we are going to take the variable consideration? Either expected value method or most likely method, the standards gives you. So you can consider this. But the standard also put a constraint. When you are taking the variable consideration, the standard gives some guidelines to the constraint. Constraint means a limitation. To what extent you can take this? Because there are certain uncertainties. Things can happen or not come. All those things are based on the estimation. You are estimating the variable consideration. So to what extent you can accommodate that? They put a constraint saying that if it is probable that significant reversal of the accumulated revenue doesn't take place, then you can accommodate. To that extent you can accommodate the variable consideration. So when you are deciding on the variable consideration, for example, if I take that contract, okay, if you decide that your contract you won't be able to complete that within the specified time, you go and check. There are certain checkpoints for the variable consideration constraints. What are the constraints? We will see now. Coming back to the variable consideration constraint, there are 5 points that you have to check before taking the variable consideration into the transaction price. One thing, whether the prices are very vulnerable for the factors what is happening outside. You can't decide. If you take the construction example, you can't decide whether you can complete it or not complete it, because there are so many other things happening. For example, COVID-19 came in. So it's very susceptible. If anything happens, you won't be able to complete it. So you can't take that award as a variable consideration. Or you can't even decide that whether you can't complete it within the time, you can't take the penalty as well. So one is that. Then the other one is, if your uncertainty is not resolved over a long period of time, maybe more than 5 years, 10 years. So until the uncertainty is not resolved, you have an open transaction whether the variable consideration is this or that. You can't decide until the uncertainty is resolved. Or the contract has large number of outcomes. And the entity doesn't have enough past experience in dealing with these kind of transactions. So then you can't ascertain whether the variable consideration, what you have estimated, can be constrained to what extent. So sometimes they have to bring it down, or even you may be taking zero variable consideration because you can't estimate it. But if you do it, you have to reassess the situation at the end of every reporting period. At the end of every reporting period, you have to assess that. So these are the variable consideration, summary, or the basic points. There can be examples. I can work out the examples. If you are interested, if you like this video, please subscribe for it. Because if you subscribe, more people can be benefited by this, and it can be circulated into a wide variety of students. So the people, for the benefit of the students who are struggling, I am doing this video. You can visit my website, that is hemashamlearning.com. I will be uploading materials into it periodically, and or you can contact me on my WhatsApp, note 71 628 5734, where if you WhatsApp me for any help, I will be there, or we can form a WhatsApp group, the interested people, and we can share the video and discuss. It's all free. I am not going to charge you anything. This is an opening session, so I will not be charging anything to the students for the next 6 months. So you can benefit from my knowledge, what I am sharing, and if you have any doubts, you can always contact me through WhatsApp or my email. If you go to my website, you can see my emails, so you contact me. If you like this video and if you have enjoyed this video, please subscribe. Thank you. Take care.